Okay, everyone. Hello again, and welcome to this webinar. Welcome to the Beginner's Corner. As you may know, this is a project we are handling with FX to help beginners not only to learn, but learn to stay in the market. It's really my pleasure to have a lot of invites here, but mostly today we have Adam Rosen. He has a lot of experience, and I believe that his training plan that he's going to present today is going to be pretty useful. So please, guys, welcome Adam and pay a lot of attention. This will help you a lot with your trading strategies, okay? Anyway, I won't take any more time. We can start with the webinar whenever you want. I will be here listening as any good student, okay? Thanks all for being here, and thanks, Adam, for joining us in this project.
Welcome, everyone, to FX Street. Thank you very much for the gracious introduction. It's certainly a very big pleasure to join you today. This is a very special program that FX Street has been able to put together. And I really wanted to talk about something, and by the way, welcome to all of the usernames that I recognize and a lot of new faces as well. It's really just great to see such a big room. Now, I wanted to talk about something that I've probably touched upon in some of the other webinars in the past. I wanted to go into as much detail as possible today and really dedicate this hour to something that's helped me in my trading, I think, more than anything else. Now, to give you a little bit of background, I started my career on Wall Street in 1998. It's been some time now, and I think I've probably tried every single different approach to looking at the market, from reading every single fundamental and technical book I can get my hands on, to taking good advice from friends and bad advice from friends. At the end of the day, I decided I'm going to have to figure this out on my own, and I think that's probably the best way to get started. Please let me know, by the way, if the volume is okay and if the charts. Let me know if you cannot see the charts as well. Okay, so in terms of trading, we always make the analogy that we want to trade our own account the same way that we would run a business. I like to make the crossover to running a grocery store. We're going to start a small business. We're going to open a grocery store, and we have to do a little bit of market research to figure out if the goods that we intend to sell, if there's a market for these goods, if we're going to sell milk and meat and cheese and bread and all that other good stuff, that there will be customers that will buy that. There will be demand for that. The same way that we would look for strategies, specific strategies that would function well in a particular marketplace. And I've made the mistake over the years of finding a strategy that works and then failing to realize when that strategy stops working. I don't believe that there's any one strategy that we can use all the time in the market. The market just represents an unlimited possibilities of range, trend, volatility, volume. And for that reason, I think that traders, we have to be very, very adept in changing our strategies to suit the marketplace. Now, we have a huge advantage in trading the foreign exchange market because we can very simply look at one currency pair versus another and determine, okay, this currency pair, the euro dollar we're looking at now, it has a nice steady trend right now. A trending market is a market that has a tendency to make new highs, new lows. Great. We'll use a trending strategy. However, if we were to look at the dollar CAD, which is probably the polar opposite of the euro dollar at this point, we have a very consistent range-bound market. There are different approaches to use for trending markets and range-bound markets, and there's actually a lot more. I'll give you one other analogy, then we'll jump right into the meat of what I want to talk about. Imagine for a moment that we're a race car driver, and that a race car driver, they have the big race. The big race on Sunday is when but they spend months and months and months fine-tuning the car, trying to figure out exactly which tires work best for the car and which type of fuel and which settings on the engine and which weather conditions are best or worst for that, for that particular setup. And they probably do hundreds, if not thousands, of laps around the track, testing each variable under its own, in a very scientific way to determine, okay, these are the best settings for the race car, so that when we come to race day, we have the best chance of winning, and I'm sure we'll know that our competition is also doing the same thing, and that makes That makes that field or any, competitive athletic sports also very, very competitive. We can make the crossover to sports as well, whether it's football or baseball, that every single player has spent years and years practicing so that if they have that one moment where it really counts, that they have the best chances of succeeding. Sports is a lot like trading because at the end of the day, it's the performance that matters. Now, there's a particular method I've developed in terms of actually, testing these strategies. Step number one, and I'm going to try to chat in these notes so we can kind of keep track of what we're talking about here. And I hope we'll have time. I'd love to talk about some individual currency pairs, including the pound dollar as well, because there is an interesting story with the pound dollar. But number one, in terms of testing a strategy, okay, so we're strategy testing. Okay, let me type this in. Strategy testing. Okay. So step number one is we want to come up with a simple idea. It's important. It's a simple idea. We always, I always tend to fall into the trap of trying to come up with a strategy that's very, very complex because the market's very, very complex, and therefore we have to have a complex, very complicated strategy to match that market condition. I think the opposite is true. I think we have to come up with a very simple, singular idea. I am going to create a trading strategy that's going to work well in a very specific trading and market condition, and then I'm going to simply wait for that market condition to take place, and when it does take place, then I'm going to apply it. Okay, so let's come up with a simple idea, and it can be a trending market, and we're going to talk more about this, trending versus range-bound markets, etc. Come up with a simple idea, though, and the easiest way to do so is apply one technical indicator. It could be the moving averages, Bollinger Band, MACD, RSI. Any one of these indicators is perfectly fine. I will use one, maybe two indicators to create the strategy. I'll show you, and I have a lot of examples of actual strategies that I've worked with, and I hope I'm going to give you a lot of food for thought so you'll be able to take this on your own. Step number two is once we come up with the idea, we're going to say, let's actually go back to the euro dollar over here. Okay, so we're going to come up with this very simple idea. We're going to say, okay, the euro dollar is in a trending market, and the easiest way to identify a trending market is to draw trend lines. Okay, so the trend lines are established on a daily chart. A trend line that is sloping down means the sellers are pushing us down and the buyers are willing to pay less of a price. And we have a declining resistance, declining support, that creates a trend. Obviously, if it was going up, then it would be an uptrending market. This is a trend. So the simple idea is, how do I take advantage of a trending market condition? Well, the rule of thumb is the trend is your friend. Always try to trade in the same direction as the trend. Now, once we do that, well, it's easy to say, well, we could stick to the daily charts, and we could say, okay, I'm going to sell short every time the market tests this resistance line. Unfortunately, with daily charts, it doesn't really help us a lot because, well, the last time we tested this resistance line was beginning in December. That means that if we sold short the euro dollar, well, we'd probably still be short. And if we did not, for the past month and a half, we would not have been able to sell short. So from this point moving forward, I then move to a shorter term time frame. That could be a 4-hour chart or 1-hour chart. There's no right or wrong answer. The time frame, and I think this is a misconception by many, that there's one good or bad time frame. The time frame should match our trading style. Now, personally, I find the most comfort in swing trading, where I'll take a trade that I'll hold for several hours and maybe even several days. Because the foreign exchange market doesn't close, we have the ability to sell short the euro dollar and literally hold on to it and hopefully make, several hundred pips, if not more. So, but if we're a day trader, we would also start from the beginning. I always like to start with a daily chart, long-term time frame, but then instead of moving to a 4-hour chart or a 1-hour chart, I may move down to a 15-minute chart. There's a number of different steps that we can go down as far as decreasing the time frame to match a trading style. I want to digress just for a moment. There is a massive draw towards day trading and scalping, and I'm speaking from personal experience. Before being involved in the foreign exchange market, I was a full-time stock trader, day trader, 3 years. I'll say this with all the certainty in the world, that it is the most difficult way to make money in financial markets is short-term trading, day trading, scalping. Now, I understand the attraction in terms of stock traders, because when you day trade stocks, we aim to make 10, 15 cents, 20 cents in the stock, maybe 50 cents. If you make $1 on a day trade, that's a really big day trade. But the reason why stock traders day trade, that they have to close your trades before 4 p.m. Eastern when the New York Stock Exchange closes, or wherever your regional exchange closes, you take an enormous amount of risk, because a stock market will close at 4 p.m., the stock could close at 50, news could come out, the stock could open at 100 or it could open at 20. Now, if I'm entering the market with the intention of risking 20 cents to try to make 20 cents in a day trade, well, if the stock gaps open $10, $15, $20, that could not only destroy the trade, that could destroy my career as far as day traders are concerned. Because day traders use very, very large position sizes relative to their account. They use a lot of margin to make a very small amount of money consistently. With foreign exchange, with Forex, we don't have that risk. This market opens at Sunday at 7 p.m. or 4 p.m. Eastern, depending which broker you use. It's open 24 hours a day. It's open through the Friday close. So we have six and a half days without the possibility that the euro dollar will close at 128 and open at 138 or open at 130. We rarely, if ever, see any kind of gaps. Normally, in terms of stock day trading, we have 2-to-1 leverage, or at the most maybe 4-to-1 leverage. But stock day traders, when you work for a day trading company, they'll actually give you much more. They'll give you 4x type of leverage, but they also take on a lot of risk. And actually, to be honest, I haven't day traded stocks in quite a long time, so the industry has changed a bit. But typically, when we get into a day trade in stocks and you decide to buy 1,000 shares of a stock with the intention of making 20 cents or losing 20 cents, when the market closes, then anything can happen at all, and it's very, very dangerous. And when I trade stocks now, I prefer personally to trade stocks in the form of options, because options you have a limited amount of risk. But I don't want to digress, because we have a lot to talk about in the Forex market. This is why we're all here. Okay, so we have a downtrend on the euro dollar in the daily chart. Now we've moved to a 4-hour chart. I'm a swing trader, so I'll move to a 4-hour chart and go to the Bollinger Band. Now the Bollinger Band is a very easy indicator to use. We have a 20 simple moving average, which is SMA, which is the center line. And we have an upper Bollinger Band and a lower Bollinger Band, which is simply this simple moving average, extended 2 standard deviations above and below the center of the range. In a downtrend, we only want to trade in the same direction to the downside. So I only want to look for trades and sell shorts. Now, to sell short, and the way the Bollinger Bands with the 2 standard deviations work is that with 2 standard deviations, if you plug the math in, about 95% of the candlesticks you will find take place in between the upper band and the lower band. Only about 2.5% of the time does the market travel below the lower band or above the upper band. 2.5% of the time below the lower band, 2.5% of the time above the upper band. So logic would dictate that if we're in a downtrend, number one, we want to sell short. Number two, we want to do so when we have the best probabilities of making money and the least probabilities of getting stopped out. Well, to do so, I would want to sell short right near the upper band. Now, some traders will take profits in the simple moving average. Some traders will take profits in the lower Bollinger Band. There are different, pros and cons to either approach. But this right here, that is our strategy. Now, I'm going to give you later on, I want to talk about a few different ideas for different strategies, but this is a strategy. And if we were to apply this to, let's say, the dollar CAD chart, dollar CAD, there we go. No, it's dollar yen. There's dollar CAD. Okay, in dollar CAD, we do not have a range. Now, we can still apply the Bollinger Bands, but in a much different way. Not actually a much different way. With a range-bound pattern like we have here, where the resistance is moving lower and the support is inclining higher, we would still use the Bollinger Bands. We would still go to a 4-hour chart, but then we would adopt a buy low, sell high approach, where we'd buy near the lower band, sell near the upper band, and take profits in the middle. So, 2 very, very simple examples, 2 indicators. Number one, the trend lines, daily charts. Once we determine the condition of the market on a daily chart, then we go down to a shorter term chart to really try to find a better entry. Now, that's our strategy. Step number 2, first of all, we had a simple strategy. Now we know what it is. Step number 2 is open a 30-day demo account. Every single Forex broker out there has it. Some even give you more than 30 days. I like to use 30 days. Now, to be perfectly honest, I think it requires probably more than 30 days to test a strategy, because I'm sure you know the market has experienced a very low amount of volume since September of last year. So, you know, to trade a market, to trade a strategy for only 30 days really isn't enough. But at the minimum, I'll do 30 days. To answer your question, by the way, yeah, according to the Bollinger Bands right now, 4-hour chart, euro dollar, we would look for a sell signal. And with the anticipation the market's going to continue lower, we place our protective stops above the highs. We can use further steps for confirmation. Personally, I would wait for maybe on a shorter term time frame. We would go to, let's say, a 1-hour time frame. I'd like to look for red candlesticks to emerge. Meaning, I have a rule of thumb. I never like to buy a red candle. I never like to sell a green candle. If the euro dollar is going to go down, and I trust that it will eventually, I want to wait until the candlesticks give me the final confirmation. The candlestick confirmation, by the way, is my last step in confirmation with every single trading strategy. Sometimes I fail to mention it because maybe I kind of assume that everybody does the same. But always wait for the candlesticks to finally confirm our belief. There's no reason to sell a green candlestick. If we had sold the green candlestick about 4 hours ago, we would be sitting out of the money right now with a small loss. So it's always better to wait for the candlestick confirmation. But aside from that, yeah, this is the spot where I'd want to sell a short the euro dollar, according to that strategy. Okay. Step number 2, open a 30-day demo account. Very, very important. You know, I think that a lot of traders new to the market, they say, well, you know, the broker's giving me a demo account so I can kind of test out to see how the platform works. So I can play some buy trades and sell trades. I can see how the margin moves and my equity, and that's all very, very important as well. But the demo account allows us, you know, it does the same thing as an athlete or a race car driver or, you know, anybody involved in this type of performance-based profession, that a race car driver will never show up to the race 5 minutes before it's ready to start, right? And just turn on the car and start driving. I mean, this is months and months of preparation. Professional athletes that play football, baseball, any sport, they spend virtually their entire adult lives and most of their, you know, adolescent lives practicing the sport so that when they finally get to the major leagues, when they finally get to the professional level, there's absolutely no guesswork involved at all. Our trading capital is just as important. We would never, we would never think to enter the professional athletic arena without first spending years and years practicing so we don't embarrass ourselves. Well, money for me is even more important than the embarrassment. I don't want to place any live money into the market until I've gone through this very rigorous testing. But the benefit is once you've done so, you're going to find, and this is something I've found, that when you turn on the computer in the morning, when you open up the charts, there's no guesswork. I have a strategy. I have a system that I'm looking for. I know this system because I created it. I know the system because I've tested it on a demo account and I've traded it with live money, so I have the confidence to know that as long as XYZ conditions still exist, that I have an X percentage chance that, I'm going to make money doing so. Okay, open a 30-day demo account, and we want to start placing trades and I find it helpful to write down the rules. Say, okay, step number 1, daily charts, look for a trend. We have that. Step number 2, shorter term chart. It could be 1-hour chart, 4-hour chart, 15-minute chart. Look to another indicator for that entry. That could be Bollinger Bands or RSI or any other oscillator. Okay, now, when I'm going to place the trades, and what I do is I maintain, and I guess this is part of step number 2. Step number 2.5 would be also to track the results in an Excel sheet. Microsoft Excel, which I believe is the number 1 most important tool for all traders, is Excel. It's just such a great way to evaluate data. I use Excel with everything I do in terms of, I have hundreds of Excel sheets of failed experiments, of successful experiments, of ongoing, tests and ideas. Greatest way to track your idea. Now, when we're going to test the system, this is what we're going to do. We're going to look for trades, and we don't have to follow the 17, 18, 22 different currency pairs that are available. Some brokers offer up to maybe 90 different currency pairs. It's perfectly fine to just trade a universe of currency pairs that we're familiar with, such as the dollar crosses, euro dollar, pound dollar, Kiwi dollar, Aussie dollar, etc. Or the yen crosses. I've run through an Excel spreadsheet placing hundreds and hundreds of trades on only the yen crosses. I was looking for a particular market condition that happened to be trendy, and the yen crosses at that time were very trendy, so I only looked for trading signals on the euro yen, pound yen, Aussie and Kiwi and CAD yen, not even the dollar yen. Okay, so when we're placing the trades, place the trades. We want to place as many trades as possible. To give you an idea, I want 50, 100, 200 trades on that statement, on that Excel sheet by the time the 30 days is done. So if we have 20 trading days in a month, and we place 5 trades a day, we're going to have 100 trades at the end of the month. 100 trades is really what I kind of shoot for. 50 is okay, 100 is better, 200 is even better than that. Now place the trades, and I'll show you how I do so. Place the trades with multiple stops and limits. Now, I'm a swing trader, so I'm looking for trades that will make anywhere from 30, 50 pips, 100 pips, 200 pips. So what I'll do, this is how and this is certainly up to you as well, but I use 50 pip stops and limits, 100 pip stops and limits, 150 stops and limits, and 200 stops and limits. 50, 100, 150, 200. If you're attracted a little bit more to the shorter term trading scenario, we could use 25, 50, 75, 100, or 20, 30, 40, 50. But I like to give the increments a little bit of space, because the strategy, we might not see the differences if we test it with a 20 pip stop and a 30 pip stop. Now, I track all these results on Excel because after the fact, what I'm going to do is I'm not only going to sort the results to see for my trades that had a 50 pip stop and a 50 pip limit to see what those results were, and a 200 pip stop and a 200 pip limit. I'm also going to look for all the trades that had a 50 pip stop and a 200 pip limit, and a 100 pip stop and a 200 pip limit, and every other combination. And I'm sure you can see there's a lot of different combinations. I'm probably not going to take the strategy that gives me a 200 pip stop and a 50 pip limit, but there are circumstances where day trading strategies you will find even almost an inverse correlation. I spent a lot of time years ago working with TradeStation, where you're able to backtest strategies. And, backtesting, it has its values, but I don't want to put too much emphasis on backtesting. Because in backtesting, what you do is you plug in parameters and you say, okay, I want to see what would have been the best moving average or the best setting for the Bollinger Bands and the best stops and the best limits for me to trade the euro dollar during this trend, which is fine as long as this trend continues. But as soon as this trend changes, what happens is that all the data we've backtested is really super fixed to the market condition that did exist and no longer does exist. The difference is when we forward test, we're not using as stringent of results, and we're not using as stringent of parameters, so to speak. Traders, they'll say, well, I found out a 39 pip stop and a 22 pip limit and a 19.5 exponential moving average is the best. And that's the risk in backtesting, is you end up getting cornered to very, very specific parameters and trusting those parameters. Say, well, I never realized it, but a 19 exponential moving average is a magic moving average. It's not. I don't believe that there's any such thing as a magic moving average or a magic setting. It's just more or less about finding a strategy that responds best to the current market conditions. So I use all different stop and limit combinations as well. Now, I will also make note, I'm glad you mentioned that, because I will also make note of the time of day. Whoops. Time of day, right here. Very, very important. Actually, probably one of the most important things. Now, I sat down when I was a day trader, trading stocks. I sat down with a friend of mine one day after work. Stock market closed at 4 o'clock. And we went back and we wanted to see, this was, I think, 2002, 2003. The stock market was starting to develop a nice little rally. And we wanted to see, the market went up that day. The stock in the Dow was up 200 points. What was the high of the day for every single stock? And my friend and I went through and we scanned the universe of hundreds of different stocks. And we found out that in the stock market, and I don't know if this is still true, more or less I think it is, that the stocks that we scanned hit their daily high at almost exactly 11:15 a.m. Eastern. This, I don't know if this necessarily still applies now. The market, again, always changes a little bit. But there's a very important premise of active and inactive market hours. And we will have different trading strategies that should be applied during active and inactive market hours. Active hours in the U.S. conventionally are considered, and from my own testing I've kind of confirmed this, in the U.S. 8 to 10 a.m. Eastern. In Japan, it's 7 to 8 p.m. Eastern. And in Europe, it's 3 to 4, 3 to 5 a.m. Eastern. Now, on my own, I tested a particular indicator, and I placed, I think it was like 200 trades. And the trades that were placed between 8 to 9 a.m. Eastern, this is actual, I don't remember exactly the statistics, but the trades that were placed between 8 to 9 a.m. Eastern, 70% of the trades are profitable. And the trades that were placed between 9 to 10 a.m. Eastern were 83%, I think it was 80-something percent profitable. Unbelievable. 9 to 10. The trades placed between 10 to 11 were 27% profitable, and the trades placed between 11 to 12, meaning noon Eastern, 0% profitable. There's something that occurs in the market. Once news is released, stock markets and bond markets open up, the banks open up, everybody who wanted to buy or sell does so, and then the market has a reason to move, but then they basically conducted a transaction, and that's the end of the day. Now, the stock market will also tend to get a little bit volatile at the end of the day, but it's a much more dangerous period of time. There's an old expression in stock trading that the amateurs open up the market and professionals close it. Much, much more difficult to predict how the market's going to behave at the end of the day in terms of the stock market. Foreign exchange market, we know the market's open all the time, 24 hours a day. But stock market still opens at 9:30 a.m. Eastern in New York. The bond market opens at 8 or 8:15. Economic numbers are usually released at 8:30 a.m. Eastern. So the foreign exchange market is just simply reacting to all of these other factors at work. So write down the time of day on the Excel spreadsheet. And actually, I don't know if I can do a very good job of this. I hope everyone can see. You should see here Excel spreadsheet. So this is just to give an example of what I'm going to do. Okay, across the top, I'm going to put the dates, first of all. Then I'm going to put the currency pair. Then I'm going to put, Excel is such a great tool because we can expand it. Please let me know if you can't see this, by the way. So we put the currency pair, and then we're going to put, if we're using some kind of indicator reading, like for example the RSI, I may want to make a note that the RSI equals 70 or 60 or 20, because then the more data that we're able to collect during the scientific process, we can go back in time after the fact and say, okay, well now I want to sort all the results and say, okay, let me see all the profitable trades, and let me see if the RSI had anything in common, or let me look for all the RSI indications that are in between 30 and 70, which are considered in the middle of the range. Let me see if there's any correlation to the profit. Then we'll look at time of day. And what's really cool is on a lot of brokers, what you can do is you can export your results page into an Excel spreadsheet. So you can, after the fact, you can go back and you can literally take your entire results page, export into Excel, and it's very easy to work with the data. And I promise it's all very, very easy to do once you get the hang of it. If you're not so familiar with Excel, there is a ton of information on the internet for free. So if there's anything you're not sure of, it's out there, and it's really, really easy to use. And of course, at the end of the day, I'll also look for the profit and loss. to see if I made money or lost money in the trade. That's certainly important. And stops, limits, and then, what we can do is we have all this data, and once the data is done, we can look to see the percentage profitable. And you want to look for the percentage profitable with certain stops, certain limits, certain RSI indicators, certain currency pairs, the time of the day, and even if you want to take a step further, if you find out that, the currency pair, this is the euro dollar, and this is the euro dollar, and this is another one, and all three of these trades, made money, here's all I made 100 pips in each trade like that, then I say, the euro dollar, there's something in common with that. What I can do is then look to the euro dollar daily chart and say, the euro dollar, for some reason, the strategy did very well on the euro dollar. Let me look to the euro dollar to see if there's something in the charts, and that's different from, we looked at the dollar CAD, another one, and let's say we lost, 50 pips here, lost 50 pips there, and lost 50 pips again. I can see very, very clearly, the strategy is responding well on the euro dollar, but not on the dollar CAD. And then, just as Joe just mentioned, I create 100 different graphs and charts and trend lines and all this other good stuff, just so visually I can very easily look at the data. The worst thing that happens is we spend 30 days going through this exercise, and we learn that the strategy that we thought would perform well did not. I promise there's absolutely nothing to lose from doing so, and at the end of the day, at the end of the 30-day demo count, you're going to look at that strategy in a completely new light, because it's not only looking at the data. Look, I could give you the data from my strategies as well, and you could plug them into the charts and start trading today. But there is such a valuable amount of information that I learn not from the results, but by placing the trades every day, because it's mechanics of placing the trades. It's just the same way a baseball player, I could go to a professional baseball player, a coach, teach me how to hit a home run. And he could probably teach me, the exact correct way to hold the bat and the timing and what I'm looking for and to analyze a picture and all that other good stuff. But there's nothing that replaces the time spent in the practice, learning the nuances of the game on my own. Very, very easy. To create a graph, I don't want to take too much time now, but very simply, you just highlight the data, and then, different Excel versions of Excel have different ways, but it's very, very simple. You just click on the information, and the graph comes up like that. Now, so we looked at the time of day. We're going to put all the results into all the information to an Excel spreadsheet. Be realistic. Sometimes I start a little bit too ambitiously, and what happens is that there's so much information trying to keep track of, it's impossible to maintain that Excel spreadsheet. So try it on a simple basis, and then you can move forward. And there's nothing wrong with testing 2 or 3 different strategies at the same time. Just, again, be realistic in the sense that, okay, the active hours, I'm going to be looking for the strategy in these entries. I'm going to be pretty busy. So maybe a good thing is to test, if you're going to test more than one strategy, test one strategy during active hours and another strategy during inactive hours. Okay, let's get to some of these strategy ideas now. Now, these are ideas that either I've used in the past or I have a million ideas out there. I just literally have not had the time to open up a demo account and to start plugging in these trades. One of these days, when we're all independently wealthy, we'll have more time to do so. Until then, we have to budget our time. Okay, so here's some ideas for strategies that very easily you could plug in on your own. We talked about the trending strategy with the euro dollar. We started with the trend line, and then with the trend lines, then we go down to the Bollinger Band to look for the entry. Here's another idea. Go back to the daily charts, and we take away everything here. Take away the indicators, take away the trend lines. How do we know that it's a trending market condition? This is, I think, something I talked about before. I'll plug in a moving average. Simple, exponential, doesn't make a difference to me. 30 moving average, there's nothing special about the number. It's just a short-term moving average. Then I'll plug in another moving average, and that will be 60. There's no reason except for the fact that the increment from 30 to 60 is a double, and, that makes sense to me. So the blue line is the 30 moving average. The violet line is the 60 moving average, and we'll do one more. Moving average, we'll take a different color, green, and we'll make it 90. 30, 60, 90. This is the trending market condition according to these moving averages. When the 30 is below the 60 and the 60 is below the 90. And we can zoom out in this chart to see when this trend started. This trend started September of last year. Now, this may be too much. These moving averages may be too spread apart. That if we're looking for a trending market condition and we want to sell short the euro dollar, to sell short the euro dollar here, it would not have been a good idea at all. Because, even though the 30 moving average was still below the 60, the fact of the matter is we had a massive recovery. So we need to now adjust the moving average. Let's not use a 30 moving average. Whoops, I'm sorry. Please let me know if you should see the charts now. Please let me know if you cannot. Okay, so the blue line is the 30 moving average, violet line is the 60, and the green one is the 90. Okay. Now, unfortunately, these moving averages, they're not sensitive enough to the market where that it'll tell us not to look to sell short. Because remember, this is our daily chart, and this is telling us sell short the euro dollar according to a shorter term time frame, as long as the 30 is below the 60 and the 60 is below the 90. But this is not a good approach, because the 30 is still below the 60, even though the euro dollar went from lows of 133 all the way up to highs of 143. That's not good. So let's use a very sensitive moving average. Let's use not 30, let's use a 5. Okay, for some reason, let me take away these moving averages and redraw them. Okay, so let's take away all the moving averages and we'll put in, zoom in here. Okay, that's a 5 simple moving average, and we'll take another one. Let's say we'll make this 10. And the 10 will be red. Okay, now here's a better example. When the market is trending to the downside, this is on the daily charts. When the market's trending to the downside, the 5 moving average is below the 10. When the market's trending to the upside, the 5 is above the 10. The blue line is above the red one. And we can take maybe one more. For some reason, I like to use 3 moving averages. So we use 5, 10, and let's use a 30. And we'll make this one green. Okay. So, what's a trend? What's a downtrend? When the 5 is below the 10 and the 10 is below the 30. What's an uptrend? When the 5 is above the 10 and the 10 is above the 30. Over here, I'm trying to remember which color is which here. The 5 is above the 10, but in one case the 10 was not above the 30. Or I'm sorry, the blue one is the 5. Sorry, okay. So the blue one is the 5, the red one is the 10, and the green is the 30. So, in this particular case, this is not a trending market in this little area right over there, approximately, because the 5 needs to be above the 10. The blue has to be above the red, and the red has to be above the green. So this is a trending market, right here. And it's a trending market up until this spot. These 2 vertical lines mark off the uptrend. The downtrend starts when the 5 is below the 10 and the 10 is below the 30. This is a trend to the downside. Okay, that's on the daily charts. Now on the daily charts, we have this trend that exists. Now we want to look for the entry. Now we can go to a 1-hour chart. We can say, okay, we know as long as, take away this line. Here's a 4-hour chart. Okay? So take away that line, take away this one. Okay. So this vertical line, remember, we drew this vertical line on a daily chart. Here's a daily chart. This marks off that downtrend started again. This date, by the way, is November 8th of last year. The downtrend is now official. Now we go to a 4-hour chart. We go back to November 8th. That's a vertical line. We can throw another indicator. We talked about the Bollinger Band as a basis to enter the market. We can use something else. An oscillator like the RSI, Relative Strength Index, measured on a scale 0 to 100, we want to sell short when the market crosses above 70 and back below. We want to buy when it crosses below and back above 30. But remember, we don't want to buy because it's a downtrend. When there's a trend, only trade in the same direction. Well, ideally, we want to sell short when the RSI crosses above and back below 70. It didn't happen at all here. So that strategy, we would have had no trades. And, eyeballing the charts, this is really the first step in coming up with an idea for a strategy. So go to a 1-hour charts. 1-hour charts, all this is a trend, by the way. So we know, and it started from the beginning of November, and this chart only goes back to the end of November. So all of this market condition, we were in a trend. So in all of this market condition, we wanted to sell short every time the RSI crossed above and back below 70. And I'm drawing the vertical lines here, and this is the first step in any strategy, is just drawing lines on the charts. I would have sold short here, 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 and here. Every single vertical line marks the spot on a 1-hour chart where I would have sold short the euro dollar. Based on the fact on a daily chart, we're in a downtrend. Remember the moving averages. But on a 1-hour chart gives us the entry. Long-term charts, and I'll type this in here. So in terms of trading, creating these strategies, okay, long-term charts is used to identify the market condition. Short-term charts, trade entry. Now we have a basis for a trade, and we would have sold shorts on November 30th, again on December 20th, again on January 3rd, and again, actually a couple hours ago. Okay? Only times in the past month and a half. That's actually not bad. But remember, we have 17 different currency pairs. So at the beginning of the day, we know what the basis is for our strategy. I'm going to set up a chart. You know what's really cool about these charts is when you minimize them, you can see all the charts together. What I'm going to do is set up all my daily charts with those moving averages, the 5, 10, and 30 moving average. And every day, I'm going to very quickly scan the charts and say, okay, the euro dollar is in a downtrend. Someone asked about the pound dollar. We can look at the pound dollar. The pound dollar is also in a downtrend. Well, I don't know. We can plug in the moving averages. There's a 5 moving average. We have a moving average. I know it was a 10. We'll make that a different color. We'll make that blue. And then we use, what was it, the 30, right? So the 30 moving average, we'll make that red. Same moving average as before. The pound dollar has officially been in the downtrend. 5 is below 10, 10 is below 30 since November 16th. And maybe once or twice we can see the 5 moving average actually did cross back above the 10 moving average, but currently that would not have applied. And then we go to a 1-hour chart, we throw in the RSI, oscillators, relative strength index. This is the pound dollar. And the last time the pound dollar, according to the strategy, gave us a signal to sell shorts was right here, which is January 3rd. Selling short the pound dollar, there was a double top right around 156. It's now 153. Not too bad. Question is, RSI above 70, below 30 at times indicates a strong trend, I think. You are correct. There are different uses for the RSI. I hope we have time to talk about it as well. I'll talk about it right now, actually. Okay. So this is a trending market strategy. When do we look for these trades? 8 to 10 a.m. Eastern, active market hours. That's most likely when we're going to get this, when we're going to get these signals. You'll find over time that you're not going to see too many extreme moves outside of the active market. Sometimes there's a little bit of spillover, but not so much. Now, there's another strategy. Now, I actually currently use. It's not with the RSI, so with a little bit of a different approach, but it works under this premise. The premise is this. Look at the daily charts. This is pound dollar. Pound dollar, the RSI on a daily chart crossed below 30, and this occurred on September 8th of 2011. The pound dollar at that time was around 158, 159. From 159, we went down to lows of 155. We went down another 400 pips, and actually very, very quickly. Now, there is an idea, there's a theory out there, which I happen to agree with, that when the RSI crosses below 30 the first time, it actually has a really good chance for the market to go a lot more. The RSI crossed below 30 on September 8th. It closed at 159.54. Let's say 159. The RSI then crossed back above 30 on, or just barely touched 30 on September 20th. So September 8th to September 20th, we could say the pound dollar was in a very strong trend to the downside. And from 159, we went down to lows of 156.50. We went about 400 pips, September 8th to September 20th, 12 calendar days, about 2 weeks. The pound dollar went down very quickly. Let me zoom in if I can here. Right over here on the left-hand side of the charts. That's what happened with the pound dollar at that time. Now we can look at the euro dollar, go to a daily chart. I think the RSI is actually pretty sold off right now. We take a look at the RSI on the euro dollar, touch the 30 level. We'll first touch the 30 level on December 12th. We were at levels of 131. The market now is at 128. So the first time the RSI crosses below 30 or crosses above 70, my idea, my suspicion is it has the possibility to go much further. And that's good. That's good. That we're able, and that's really a beautiful strategy because you're able to identify a very specific market condition. Specific market condition, the RSI has just crossed below 30 and has not yet crossed back above 30. When it goes below 30, it can go to 29, 20, 10, or 1. We don't know how far it's going to go. But all we know is that because the RSI is below 30, there is definitely a lot of selling pressure. Can't say the same thing when the RSI is 51 or 34 or 69. So that's another idea for a strategy which I happen to really subscribe to. It's a great comment that you brought up. Okay, so we talked about trending strategies, the moving averages, Bollinger Band with an entry as well. Now, there's a different idea. Let's go to the dollar CAD. Okay. So the dollar CAD, we know, is very range-bound. Daily charts, range-bound. Plug in the RSI, and again, remember, the daily chart, we're just trying to identify the market conditions. If the RSI in a trending market has a good chance to go above 70 or below 30, the opposite holds true for a range-bound market. A range-bound market, I would classify as the RSI is in the middle of the range. The middle of the range is 50. Well, let's give ourselves a little bit of wiggle room. Let's say the RSI has to be below 40, in between 40 and 60, the middle of the range. Daily chart, RSI, if the RSI is between 40 to 60, 40, 50, or 60, or anything in between, that means we're very range bound. Let's mark off a vertical line when that first occurred. That first occurred, I would say, right about here, approximately, November 28th. So from November 28th through today, we have range-bound markets. Now, we go to a 4-hour chart. Remember, long-term charts for the trade, the market condition. Short-term chart is for the entry. Now, short-term chart, we look for the trade entry. We can look to buy near the lower Bollinger Band, sell near the upper Bollinger Band. Now, quick examination of this chart shows us if we sold short here, we would have lost money. Sold short here, we would have made money. Buying here, we would have lost money. Buying here, we would have made money. Maybe we should go to a shorter-term chart, like a 1-hour chart, and see if there's shorter-term day trades that we can take advantage of. Or maybe the fact of the matter is the daily chart, remember we used 40 and 60? It's just not stringent enough. Let's move it down to 55 and 45. 55 and 45, is right over here. That shows us extreme range-bound quiet market. And that started most recently, January 8th. Now, we drew the line here. 4-hour charts. From January 8th until now, this would have told us buy near the lower band, which was just actually low of the day today, sell near the upper band. Does everybody follow? So if, we put our theory onto the charts, and it just doesn't seem to make sense from the charts, draw the lines, try to readjust the lines and the charts and the indicators and the time frames until we find something that it looks like it'll make sense. The first way that anybody ever backtested something is, and this is the way that I started out. I mean, this is before, and I saw that somebody made a comment about MetaTrader. I'm familiar with MetaTrader. I use the charts for the charts. It's a little bit too difficult for me in terms of backtesting. If you want to look to a program that's easy to learn how to use a language for backtesting, I found TradeStation very easy. But brokers will also offer even easier methods of backtesting. But to be perfectly honest with you, this is my backtesting. Microsoft Excel. I kind of like to do things the old-fashioned way. They're just, brute force. The way I used to backtest before there was ever such a thing as TradeStation or any of these programs is I would do exactly this. I would put an indicator on the chart and I would start to draw lines. I'd say, okay, I would have bought there, I would have sold there, I would have sold here, and I would have bought there. And then I would take out, not even Microsoft Excel. I remember the days of just a piece of paper and a pen, just writing down, okay, I bought there, what's that price? Write it down. I put my stop there, I use a 50-pip stop. Did I get stopped out? Yes. Did I take a profit? No. Now, fortunately, we have the ability to use demo accounts and Excel spreadsheets. It's a lot easier these days. But I still like to kind of, do things as manually as possible. But, really, really great stuff. Now, other ideas. We talked about range bound. We talked about trending. These are just a couple indicators. There's a whole universe of them. Now, a couple other quick ideas while we have some time. In some of the other FX3 webinars, we talk about a system where we identify the strongest and weakest currency pair. And this is all just food for thought. Now, remember, for some of you might remember, we do this. I take the daily charts of the euro-dollar and I plug in the RSI. Euro-dollar, RSI. Well, what's even easier is if we use the yen crosses because the yen is the second currency in all those pairs. So go to the euro-yen, daily charts, RSI, and I think quite a few of you probably know what I'm talking about. Just write down what the RSI is. 34 euro-yen, daily charts, RSI. RSI equals 34. Pound-yen, daily chart, same time frame, RSI. Plug it in right now. RSI 28. Pound yen 28. Go through with all the different yen crosses. Euro yen, pound yen, Aussie yen, Q yen, etc. What you're going to find is, and unfortunately we don't have the time to run through all the currency pairs to do this, but what you're going to find is I'll just make up the numbers. The euro yen is 34, the pound yen is 28, the Aussie yen is 54, the Kiwi yen is 72, the CAD yen is 55, etc. Well, what we're going to do is we're going to look for the strongest and weakest currency. Well, according to this, the strongest one was, I forget which currency it was, but it was 72. The weakest one is the pound at 28. Now, we're going to put the two together. If the strong one, and this, I'm making this stuff up, but if the strongest RSI was the Aussie and the weakest one was the pound, this gives us a currency pair, pound Aussie. We take the strongest and the weakest, we put it together according to the daily chart RSIs, and lo and behold, now you have a currency pair that we know has a very strong trend. On the other hand, you can take two currency pairs. One has an RSI 55, one has an RSI 54. That could be the dollar CAD. I don't know. I'm making this up. But that tells us the currency pair is range bound. A very, very simple way to evaluate the market from a basis of relative strength to determine, okay, what's the strongest, what's the weakest, put the two together. Or put two strong ones and two weak ones together, find range bound. We talked about time of day. During active hours, make sure your strategy, you're looking for a trending strategy. Make sure you're looking for something to happen. New highs, new lows, or at least trend continuation. During the inactive hours, when the market's kind of quiet, noon Eastern, double tops, double bottoms, regression to the mean. Do not expect the market to break out the new highs around lunch. Everybody's at lunch. Nobody's trading. Look for also, there's so many different ways to do this. Correlations. 4x in gold, 4x in stocks, 4x in bonds. I have an idea. I haven't tested this yet. I just haven't had the time. The 10-year U.S. Treasury bond yield tends to move pretty closely with the U.S. dollar. The German Bund, 10-year German Bund yield tends to move pretty much, close to the euro currency. I always wanted to put together some kind of strategy that would give me 4x signals based on what the bond market's telling me. So I would see the 10-year bond in Australia is up, the 10-year bond in New Zealand is down, the euro, the dollar, the pound, etc. Every nation has their own 10-year bonds, and I'd like to compare those bond yields, and maybe that would give me some kind of insight into where foreign exchange market's going to go. Because remember, stocks move under the anticipation of greater or worse earnings, corporate earnings. In terms of the bond market doesn't really care about earnings. The bond market cares about fundamentals, economics, non-farm payroll, CPI, the beige book, things like that. Where is the money leaving euro? If the money is leaving the euro, where's it going? If I understand your question correctly, capital is going out of the euro. It's finding another home, and chances are, I don't know, but chances are it's going to be in with the other G8 countries. If I had to guess, I would say it was $1. I say if the euro's going down, the dollar's going up. I think it's $1. Unfortunately, that's all the time I have. Wow, this hour went fast. I want to thank you all very much for joining us. Very special thanks to FX Street. Certainly is a very nice program they've been able to put together. And very special thanks to Valerie as well. Please see FX Street's calendar because we have much more to talk about. Again, I want to thank you all very much for joining us. Wish you a great day, all profitable trades, and we look forward to seeing you back soon. Back inside FX Street.
Okay, everyone, let's thank Adam a lot for what he did here today. It was really great. I really enjoyed it as much as you did. And we were going to review this, and I will add a bit of my own experience to this in a couple of weeks, okay? We are going to be with a review of this webinar in 2 Thursdays from now, okay? Thanks again all for being here. Thanks, Adam, and hi, Joe. I do my daily analysis written, okay? Not spoken. You can find it at fxrate.com, Currency Mayor's Technical Analysis, okay? Anyway, thanks all, and thanks, Adam. See you back in 2 weeks, okay? Thank you.